Hey, soldiers, as you know, the United States of America is in the midst of a debate about raising the debt ceiling. Now, the previous debt ceiling, which was set in 2021, has already been exceeded. It was $31.4 trillion. And we are now at $31.7 trillion in terms of the national debt. Now, the United States debt has risen 400% in the last 20 years. So the debt ceiling, they want to, play this game where they raise it again, and invariably we will exceed it again and have to go through this whole debate all over again. But there is a way that you can actually prosper from this. We are soldiers of finance. In every situation that comes down the pike, we're going to find a way to make it an opportunity, okay? And we're going to get into how the debt ceiling could actually help you, all right? But first, let's understand that Janet Yellen, okay, she's out there telling more lies, okay? This woman, she swore we weren't going to have inflation. Now she's saying the United States has never gone into default. That is not true, and that's important to understand when you hear all of this news about the debt ceiling and the sky is falling. Look, the reality is they're going to reach an agreement. That is the reality, okay? Unless they all just disappear tomorrow, an agreement will eventually be reached. There is a lot of political posturing going on. Now, they're saying that, unless we get this under control, June 1st could be the, drop dead date in terms of a default actually occurring. This is also Yellen who is saying this, okay? So I take everything that she says with a grain of salt because in this situation especially, either way it's troubling. If Janet Yellen does not understand that the United States has indeed defaulted before, that's a problem. Or if she's just lying about it because she knows the majority of Americans don't know the history, then that's equally as troubling.
As many of you know, I have asked Congress to raise or suspend the debt limit. Since 1789, the United States has paid all of our bills on time, and it should stay that way. In my assessment and that of economists across the board, a default on our debt would produce an economic and financial catastrophe.
Well, Janet, we're actually beyond the wire because the ceiling was $31.4 trillion. Now it's 31.7. Don't know if you're aware of that, Madam Yellen, or whatever your title is over there as Secretary of the Treasury, whatever the honorific is, okay? Now, let's also notice something in this entire debate. There are only a few people talking about controlling spending. Now, there is some language to that effect in McCarthy's measure that he is debating with the White House. There needs to be more going on there. But that's the problem we have. We don't have a debt problem. We have a spending problem. And until America realizes that, we're going to continue in this exercise of raising this debt ceiling. Would that you could just raise your debt ceiling when you needed more money. But see, we can't do that here as small business owners and individuals. Now, Janet Yellen told a bold-faced lie. This woman was a professor, so I know she has to know the history. That in 1934 and 1971, the United States of America did indeed default on obligations that it had. Okay, let's go over the history. In 1934, we had what was called the default on Liberty bonds. The United States defaulted on the fourth Liberty bond. The contracts between debtor and creditor on these bonds was very clear. The bonds were to be payable in gold. This presented a big problem for the U.S., which was facing big debts into the 1930s after the First World War. By the time Franklin Roosevelt entered office in 1933, the interest payments alone were draining the Treasury of gold. And because the Treasury had only $4.2 billion in gold, it was obvious there would be no way to pay the principal when it came due in 1938, not to mention meet expenses and other debt obligations. These other debt obligations were substantial. Ever since the 1890s, the Treasury had been gold short and had financed this deficit by making new bond issues to attract gold for paying the interest of previous issues, kind of like a Ponzi scheme. The result was that by 1933, the total debt was $22 billion, and the amount of gold needed to pay even the interest on it was soon going to be insufficient. So how do you think the United States of America dealt with that situation? Well, Chamberlain notes, this is the author that did the review of this history, John Chamberlain. He notes that Roosevelt decided to default on the whole of the domestically held debt by refusing to redeem in gold to Americans. So I guess Janet Yellen is not recognizing the American citizen as being, important when it comes to the United States of America, the government actually paying its debts. Moreover, the Gold Reserve Act of 1934, Congress devalued the dollar from $20.67 that is, per ounce to $35 per ounce, a reduction of 40%. Or, put another way, the amount of gold represented by the dollar was reduced to 59% of its former amount. So that constitutes a default. They did not pay on that. So that's one set of facts that puts what she just said to utter shame. And then, if that wasn't enough, we had the short default of 1979. This was a second and less egregious case of default, but a case of default nonetheless, in April and May of 1979, amid computer malfunctions, heavy demand from small investors in the wake of the congressional debate over raising the debt ceiling. The U.S. failed to make timely payments on some $122 million in Treasury bills. The Treasury characterized the problem as a delay rather than a default. Now, try that with your credit card company. Call them and say, hey, look, I missed a couple of payments, but let's characterize that as a delay, not a default, and see how that goes down. While the era affected a fraction of the 1% of U.S. debt short-term interest rates, then around 9%, jumped 0.6 percentage points, and the U.S. was promptly sued by bondholders for breach of contract. So what Janet Yellen said was not factually correct. The U.S. has missed payments in the past. Now, what would it look like if we defaulted on the debt today? And how could you prosper from that? Now, I want to just stress, we're not going to default here. Sure, it's all funny money, all right? They're doing things with math that all of the numbers are just, messed with, stepped on, and, perverted, all right? You've got to look so far into these sets of data before you can get an accurate picture of what's going on. I'll tell you, unemployment, for example, they're playing with that number. They are coming out and saying that, okay, unemployment's up. But then if you look back into previous reports, they'll revise those down. All right. And this is an ongoing pattern of behavior that the Bureau of Labor Statistics has been engaged in. Okay. In an attempt, I think, to make the administration look good in advance of the 2024 elections. So you've got to really drill down into these numbers if you want to understand what is truly going on, because what's reported in the mainstream media, look, even if they were telling the truth, they can only tell partial truth, because any news station you're watching, how much time do they actually devote to this stuff? All right. In the best case scenario, 3 minutes a story. Okay. So you can't get down in the weeds on any of this stuff. I'll tell you something else about that BLS report, Bureau of Labor Statistics unemployment report. A lot of people think that thing is based on the unemployment checks that go out. Okay. Bureau of Labor Statistics doesn't do it like that. They have a household survey that a few thousand people in a country of 325 million are surveyed every month. And those survey results are tabulated to give you those unemployment rates. Then, on top of that, the media reports what is known as the U3 rate, which is far less all encompassing than the U6 rate, which is never reported. All right, at least not in my experience when I was watching the news. I never heard them report the U6 rate because it's always higher. And Democrats and Republicans alike like to go for that lower number, and the media is complicit in helping them by only reporting the U3. Now, what would happen if the government defaults on its debt? We're going to get shortly to how, even though that's not going to happen, you are going to be able to have an opportunity, at least, to prosper. Another debt ceiling crisis is approaching, and it's in no one's best interest, if it happens, of course. All right, so what if the default takes place? To better understand the risk, and they are substantial, this publication, the Real Economy blog, did some modeling, and they came up with the following. We modeled out a number of scenarios to estimate the probable outcomes on unemployment, growth, and inflation. In a separate article, they also go a little deeper into detail, but this is all we need. They look at two scenarios for default. The first is a technical default. The first scenario, the technical default, which is defined as an extended period of non-payment of some or all U.S. financial responsibilities. Based on our shock model, a technical default would double the current unemployment rate of 3.4%. Now, understand, if we look at the U6 rate, they are reporting the U3. Okay, there we go again. You look at the U6 rate, that's higher. So let's double that U6 rate, right? Pay attention to that. And the BLS report is oftentimes less accurate than the Fed's report. But the Fed's unemployment report takes months to issue, okay? BLS, what they make up for in speed, they lack in accuracy. So in any event, look for a doubling of unemployment in a default scenario. So that would, of course, put the economy in a recession because people don't have the money to go out there and spend like they would if, there was near full employment. And that recession would occur within 6 months of that default. Now, we'd see inflation kind of cool off during that period, but then we'd see inflation spike, okay? And that would be accompanied by a deterioration in the fiscal condition of the economy. Now, there's monetary policy and there's fiscal policy. Fiscal policy is controlled, of course, by the Congress and the president. And if we see a deterioration in that policy, we can expect lower tax receipts because people just don't have the money. They're not working. They're not paying an income tax. Okay, so that's the technical. That's the least egregious one, the technical default. Now let's look at the actual default. The second scenario would be an actual default in which the government, out of money, stops paying its obligations, period. It would be an unfettered economic catastrophe. Our model indicates that unemployment would surge above 12%. Now again, they are looking at the U3 when they say that. So look for employment in the neighborhood of 14%. And that would happen in the first 6 months of a default. The economy would contract by more than 10%, triggering a deep and lasting recession. Let's go ahead and say we'd be flirting with a depression. And inflation would soar toward 11% over the next year. And also, let's talk about that inflation number, because that is even calculated on the low side. If we go back, look at John Williams' shadow stats, if they are reporting 11% inflation based on the current calculation by the Fed and the Treasury, that would mean that if we took out all of the magical calculations, okay, and took it back to the 80s, we'd have inflation somewhere in the neighborhood of 20%, okay? So I don't know what the textbook definition of hyperinflation is, but it would be scary, okay, where we would end up. Under both scenarios, the U.S. credit rating would be downgraded. The dollar would be put in jeopardy. It would be another pressure on the sanctity and the reputation of the dollar. And the cost of floating debt for both the American private sector and the government would rise. Car payments, mortgage loans, credit card, your credit card interest rates, all would go up. All right, precipitously. Based on the experience of the 2011 and 2019 debt ceiling standoffs, the base case is that the political authority will tempt fate. Okay, and that's what they're doing now. They're going to court default, putting the domestic and international economic stability at risk before striking a deal, but they will strike a deal. The deal will not accomplish much in the way of addressing the government's long-term spending imbalance. We got to address spending. We have to start cutting spending. We can't afford it. In this house, okay, we go through and we look at our expenses several times a year and say, hey, you know what? We're not using that, okay? Or we can consolidate this. We looked at one because we have two separate businesses, okay? We have a real estate business and we have a financial services. Those are our main two businesses, okay? And this YouTube channel is actually a business. We run this like a business. It is, it's a business. But on the real estate side and on the financial service side, real estate company had a Zoom account. Financial services company had a Zoom account. And for whatever reason, my wife and I were like not aware of that until we had a conversation. We got rid of one of them, right? Consolidated. Because we're never using the thing at the same time anyway, right? So we were able to do that. So, like I said, the deal won't accomplish much. The primary budget deficit, the deficit less interest owed on past debt, which is an estimation, the correct metric, stands at 3.27% of gross domestic product, okay? Putting the primary budget deficit on a path to a more sustainable rate of 2% over the next decade is something that the political authority could accomplish outside an unnecessary and artificially induced crisis. So we're going to see if we defaulted, of course, asset prices would fall. In 2011, during that debt crisis, the asset prices were pushed down, reduced household spending and private business investment also were realities. And it also eroded consumer and corporate confidence. And therein lies the solution to you actually turning this situation to your benefit. How? Well, simple. All you got to do is think asset prices are going to be lower, so therefore they'll be less expensive and you can be able to get in and buy low. Okay, buy low, sell high. That's what we want to do, right? So during this time, if you were thinking about purchasing some assets, after, of course, doing your due diligence, take a look at that asset price, see if it has fluctuated downward because of, maybe in part because of this whole thing going on with the debt ceiling debate. And if so, then maybe, and again, this is based on your due diligence and your situation, maybe it's time to make a move and acquire those assets, okay? These debt ceiling farces come along periodically, right? Last one was in 2021. Guys, now's the time to go ahead and hit that subscribe button. Also, hit that thumbs up. Do me that favor. Enlist, become a soldier of finance, and let me know you did so in the comments, and I will go ahead and salute you. All right, so that's what's going on and how you can profit from that debt ceiling debate. Okay, we really got to stop spending, guys. It's just getting to be, totally crazy. Google here recently, they used to have this thing that they would say, we won't do evil or do no evil. That used to be in their mission statement, and they dropped it. And the only reason you would drop it if you are intending on doing evil, right? Some say they always have been evil, and maybe they have. But look at this evil thing that Google is doing. They're trying to control people's thoughts. How arrogant of them. Got to resist this type of stuff, guys. Go ahead and watch that video to see what I'm talking about. Google out there trying to play Lord and Master of the very space within your cranium. We can't have that, okay? You guys are a company. You're not our overlords. Guys, I'll talk to you soon.